recording. Today we're going to be talking about um, essentially bank logic. Now, what is bank logic? As the banner said, what is bank logic? Can anybody give me a guess as to what bank logic is? As to what it does, as to what it means? What is bank logic? Like we should understand what we're studying, the name of the unit. So, what can anybody give me a guess? Smart money concept? Yeah, it's a smart money concept. How the banks move. Okay. How the banks move. Okay. Okay. Understanding the bank move. Angel, you've been with me for a while, so I think you understand what this is. But I'm going to be focusing on the more advanced concept when it comes to understanding bank logic. So, understanding a bank move. Can anybody else give me an answer? Anybody else? Can anybody else give me an answer? Understanding how the banks move. Okay. What do you guys mean by, actually, you know what? I'll explain it. That's a good answer. That's a good answer. Okay, that's fine. Let's go ahead and getting liquidity. Perfect. Okay. So let me actually explain what bank logic actually is. So let me see if I can make the sharing screen. Perfect. Okay. And this is what we're going to do. We're going to pull out the whiteboard. I know how much you guys love the whiteboard. So we're going to stop sharing here. We're going to pull out the whiteboard here. Okay. So when a bank, when as we know by now, you guys have gone over liquidity, you guys have gone over Wyckoff. When the market moves in a certain direction, we know that it's influenced by what? So let's say the market starts off at point A, right? And makes its move toward point B, which ends up being all the way up here. Make sure you guys mute yourselves when you guys come in. So we make from point A to point B. What do you guys think causes this move to go all the way up? Orders, okay. Anybody else? Bank orders, big lots, okay. Anybody else? Money injected, perfect. I like the wording that you said there, money injected. So all of you are right, orders, it's money injected. I really, really like the word money injected because the money, when you guys say money injected, that essentially means that banks in it of themselves have injected their own liquidity into the market and have at that point influenced or manipulated the market into moving in a certain direction. So at point A is when we can assume that banks themselves have entered the market with, let's assume, and these aren't too far out from the actual numbers, but let's assume that you go in with 900 million lots. And I'm going to go over very quickly the basics of this, and then I'm going to go over the more advanced concepts of bank logic. So we come in with 900 million lots in buys. However, as we discussed in Bootcamp 1, what do we also need? As soon as we buy, what else do we need?
Cells.
We need cells, right? Not only do we need cells, they need to be injected. You need to have a willingness to sell, perfect. They need to be injected by the banks themselves, because unless we have another, say, 500 million lots and people selling that are retail, the bank is going to overstimulate the market, and it's going to overshoot its point. And at that point, they're being extremely inefficient, right? So how can we essentially manage our moves? How can the banks manage their moves so that they don't overshoot their target, for one, and secondly, so that they aren't inefficient with their own liquidity or their own money, their own capital? They have to also enter the market with, let's say, 500 million lots. In what? Buys or sells?
It sells.
In
Sells.
sells.
Mhm.
Perfect. They have to come in sells. They have to come in sells because of the fact that if they don't come in sells, what's going to happen in the market? It's going to overshoot. And if it overshoots, well, you've become inefficient. And if you've become inefficient, you're wasting money, right? Since you're wasting money, they're going to have to pull back the market, and they just lost money in that endeavor, right? Or they made it a lot more annoying than it's supposed to be. So in this case, what is the result of a 900 million lot to a 500 million lot buy to sell ratio? What ends up happening is a lot of times we see something like this. All the way back up, right? Notice that at the target, right, when we reach the target, it was not a straight line. A lot of people think that from point A to B, it's going to be a straight line. It's not, okay? It's not a straight line by any means. What's going to end up happening is you will have magnets of price where price has to visit first, right? And you will have to, the market will have to correct itself due to the algorithm, right? So what's going to end up happening? A lot of times people get confused because they look at the daily and they end up looking for a bias, right? So they end up saying like, oh, the market's in a downtrend, so I'm only looking for bearish entries, right? If the market's in a downtrend, first of all, is the market even conscious that it's in a trend?
No.
The market really isn't conscious that it's in a trend. The market reacts simply off of liquidity, and it reacts off of orders, right? Because the market is moved by weight. So what ends up happening? People end up looking at the daily and they say, oh, the bias is bearish, so I'm going to only look for sells, right? No. Why would you be looking for sells if the market already made its move from point A to point B and you're getting into sells 500 pips late? Why would you be getting into that? Is there any real feasible explanation that you guys can give me that you'd be getting into a sell 500 pips late?
Means you're trade and not chasing the setup.
Right, exactly. You need to be trading. You can't be chasing a setup. Exactly. I love that verbiage. You can't just be chasing a setup, because at that point, what's the point? What's the point
Are you
in
there?
you getting in, right? What's the point? So what I want you guys to understand about bank logic is it comes very, very tied in with liquidity. Now, how is it tied in with liquidity? Well, let me come on in and let me explain to you. If there are orders, right? Let's say that we have point A right here, point of origin, and here's where I'm going to introduce another smart money concept, and it's called the return to origin, okay, or origin. What the hell? Okay, all right. So what ends up happening is, I think we need to turn this off. So what ends up happening is this. Let's say we start off right here, right? Markets are right here. Now, at this moment, we get a sharp move down. Okay. What can we assume are up here? What can we assume is up here?
Liquidity.
Liquidity. So we can draw the sign of liquidity, right, for proper notation. Whoops, what the hell? We can draw the sign of liquidity for proper notation. What else can we assume is up there in terms of bank logic?
Orders.
Distribution.
Orders.
Distribution.
Buy
Okay.
orders.
Some buy
Pull
orders,
orders.
some pending orders.
Yeah,
Pending
orders.
orders. Okay. Well, what made the market move off from here? Because the market had to move, had to be pushed, right?
The banks buy orders.
Buy orders.
Sell orders.
Sell orders, right? So you are partially correct, and let me correct your thinking here. So let's say banks have 900 million lots. Jesus, my handwriting is awful when I'm writing on my phone. So it's 900 million lots, right? To the downside. So 900 million lots is a lot more money than we probably ever will have in our lifetime. It's risking a lot more money than we can probably fathom. But at the same time, they know they're going to move the market with that. So they're going to be instantly in profit, which is perfectly fine. Next, what do you guys think is going to happen directly directly after we end up taking these 900 million lots to the downside? What do we need to counterbalance this?
To buy.
A buy. So let's say we have only 200 million lots in a sell. Oh, sorry, in a buy. Right? You need buy orders. What do you guys think is going to happen if there are very, very low buy orders to counteract the sell orders?
It's gonna keep on going down.
Is it going to keep on going down? Or will it go down in a different way?
Go down a different way.
How do you guys think it's going to go down in a different way?
Inefficiently.
Inefficiently. Perfect. I love that answer. It's going to start coming back down inefficiently. And what is it going to leave down here? And then from here, it's going to start consolidating. And what did we just leave all the way up here?
Inefficiency.
Perfect. We just left liquid gold. We left a lot of money up there. Why? There were too little buy orders to counteract the sell orders. Okay. When this ratio is too small, that is how an inefficiency is formed. This is how an inefficiency is formed. Okay. So this is something that I want you guys to understand, and this is something that I want you guys to realize. When we teach you, oh, this is an inefficiency, or oh, this is an order block, there's a reason behind it, and this is the reason behind it. Bank logic is the reason behind everything, how the market forms. Now, the market will form like that every single time that certain requirements are met, okay? And these are the requirements for an inefficiency. Usually, when price is priced in by the algorithm, usually there will be a higher ratio here, right? So between buying to selling ratio, right? There will be, it'll be a lot closer. So it'll be 900 million lots to 500 million lots. It'll be 500 million lots to 300 million lots, right? It'll be something like that. It usually isn't one extreme, the other extreme. Sometimes that happens because the bank may not have enough liquidity, and they say, okay, well, we're going to go attack these lows, right? Or like in this case, say there was a previous day low back here, or a previous structure low back here, right? And they want to raid these lows. Why would they come back to this point? Let me make it a little bit higher up here. Let's say these are the lows from like 2 months ago, right? These are the lows from 2 months ago. According to bank logic, why would the banks come back down to this position?
There's a liquidity grab.
There's a liquidity grab. Perfect. People using support and resistance are going to get stopped out. A lot of retail traders are going to get stopped out by this move. But not only that, according to bank orders, what do we have back here?
They probably have their own order too that they're trying to mitigate, right?
Exactly. Perfect, Joe. I love that answer. So what are we going to have? We're going to have buy orders, right? Oh, whoops. We're going to have buy orders that we're going to mitigate. Okay. So there's a lot of buy orders here that were taking profit around this area. A lot of them got taken profit around this area, which means that back here, they're most probably mitigated or at a break even, right? Their stop losses are at break even. So what ends up happening? What is the only other order left down here? The sell orders that they needed to use to counteract the buys that they placed, correct? Does everybody understand this? So if they placed buy orders and they took profit of them up here, right? But then they still have sell orders that they use to counteract these buy orders. What do you think they need to do? What do they need to come back and counteract?
Put another buy.
They need to counteract these sells right here. Right? They need to counteract these sells because those orders are still open if they didn't get immediately priced in as soon as they came into play. Right? Either way, there's still liquidity down there in terms of bank orders. So there's a big difference between bank liquidity and retail liquidity. And this is something that you guys are going to need to understand. So in terms of retail liquidity, a lot of times we use a smart money concept called phantoms, right? So trend line phantoms, support and resistance phantoms, head and shoulder phantoms, double top, double bottom phantoms. And essentially what these phantoms essentially are is they're what retail sees and how liquidity is going to take them out, right? So if we see a trend line, a lot of times it'll dip before, below the trend line, or if you trade with them, right, you'll only see it in hindsight, type stuff like that. Support and resistance, supply and demand, essentially the same thing. So a lot of times people will draw a line and think that price is aware that that line is being hit. Support and resistance is used, but it's used institutionally in terms that there are major points in the market where liquidity is being placed. However, instead of just saying, oh, the market has tapped this line 1, 2, 3, 4 times, and now it's going to bounce up again, without knowing why or how it's going to do it or whether or not that's feasible, it is where a lot of people fail, if that makes sense. Does that make sense to everybody? I want to make sure I haven't lost anybody. Now, I also want to focus and stress on the bank logic aspect. So does everybody understand why the banks had to come back to this previous structure low? Does everybody understand why? Go ahead, Ladarian.
You can repeat your question.
I said so. I said why is it important? So does everybody understand why we came back down to this green point to this area back here, and we said that this was like previous structure.
So it was coming from from distributing, and it came back down to your green line.
Yeah. So essentially what I'm saying is I'll repeat what I was saying earlier is let's say back here at the green line, right? Let's assume that the green line is previous structure, like it's a previous low, right? And it moved up sharply up until this point, right here where the market sold off. So what we can assume is that the market moved off of that position. Let's say volume supports it and everything. We can safely say that price has moved up to this point because of the fact that banks had buy orders in that position, right? Now, let's say they put in 900. Let's say they put in another 900 million lots for the buy, right? And they took most of their profit up here, right where the market pivoted, right? And a lot of these 900 million lots became 900 million lots in sells, right? That's perfectly fine. However, let's say that we have now fully taken out these 900 million lots in buys. What did we forget?
The sell.
The
The
sells,
sell order.
the sell order. So this now becomes institutional liquidity because what do they need to come back and do?
Mitigate it.
They need to come back and they need to mitigate, right? They need to come back and they need to mitigate these orders. Since they need to come back and mitigate these orders, it only makes sense that price comes back down here, rates these lows, and then you're good to go, right?
Right.
So that's bank logic. right? Essentially, banks bouncing from order to order is how the market moves. Now, let's say, let's continue at this point right here where we're at right now. Where do you guys think banks will most probably go at this point?
Back up to the
Just a break
upside.
in the low, probably to the upside.
They'll go to the upside to mitigate those losses up at the top.
So we have a bit of a magnet of price here, right? We have a magnet of price here. Why do we have a magnet? Well, because of the fact that we still need to fill in this ratio that was faulty, right? Now, a lot of
Yeah,
times this becomes that's an imbalance. Yeah. So what I said earlier, right? An inefficiency imbalance type thing is when the ratio between buyers and sellers is very low, or there's kind of a gap between the two ratios. A lot of times that causes inefficiencies. So let's say there's 900 million lots and only 200 million lots to counteract that. Um, a lot of times that will cause an inefficiency because there's just too many sell orders for the buy orders to keep up with, right? In terms of weight, and that's what causes inefficiencies. So this is the origin of the inefficiency. Where did this inefficiency originate from? It
From
originated from right here, right?
the top.
Perfect, right? The top. You could say right here, you could say right there. It's generally around the same area, correct? That's where the origin is. So this is a O. Okay. Now, when it comes back up here, we can essentially assume, hey, most probably it'll come back up here to fill in or instigate new power, right? New market power. What ends up happening? Comes back up here, and this is known as your RTO, or return to origin. Okay. Return to origin. Okay. And that return to origin is essentially where the market returns back up to and where it continues toward. So that RTO ends up becoming where most likely price is going to be targeted. Why? Because this becomes a void, right? And this void needs to be filled in, right? Inefficiencies, remember that usually they're only candles. Inefficiencies are usually only candles that end up being inefficient. If it's a series of candles that are inefficient, this becomes a price void, right? And usually the void gets filled in all the way and then proceeds to go through it. And if not going through it, it at least fills it, and then it creates some type of schematic that ends up going in a different direction. Does that make sense? Now, if you guys are guests here, remember, if you guys are guests here, liquidity voids and the difference between liquidity voids and inefficiencies is further discussed in Bootcamp 4. Send Jay or myself a DM afterward to know more about that. One more thing is this return to origin essentially tells us, hey, if it returns to a certain point where these orders originated from, depending on the situation or depending on the structure, the piece of structure, we can essentially assume, hey, there should be something here that gives us a direction onto where it's going. We have now discussed, so this right here becomes the origin of inefficiencies and voids. Now, a very, very similar concept here would be the order block. And the order block is a very, very interesting concept because let's analyze the anatomy of an order block. We know that an order block ends up being the last, let's say we're looking at a bearish order block, right? We know that it ends up being the last bullish candle before a move down, right? And green will signify bullish, red will signify bearish, right? So what's the order block here? What's the order block here? The red or the green?
candle.
The green.
green.
The green.
So when we look for the 50% of the green candle, it should be 50% of the green candle, right? Not the box. It should be the green candle. Which means that in the future, this is around the origin of the orders. Why do you guys think it's the origin of the orders? Why do you guys think it's the 50%? Why do you guys think it's targeted? We're taught this, but why do you guys think the 50% usually is targeted?
Because is that because of that's the extreme area?
That's the extreme area. Okay, good answer.
Is it because the 50% mark kind of signifies the average
Perfect.
of the block?
Yes, perfect. So this becomes the average. Okay, because up here, right, and let me do it in a little bit better color. Actually, I think you guys can see that well, but let me explain something. So like, let's say, so do you guys remember Power of 3? If you guys have
Yes,
gone over
sir.
Bootcamp 5? So let me go over Power of 3 really quickly, and let me tie this into to what liquidity actually is, into what into bank logic. So we know that Power of 3 consists of 3 moves, right? And the 3 steps are accumulation. Oops. Accumulation, manipulation, and distribution of profits. Now, this should not be confused with accumulation and distribution schematics.
Just about done. Hope everything's
Make sure you guys mute yourselves when you guys come in, bro.
if you heard from them. Let me know.
Okay, so let's be very clear real quick. Accumulation does not mean the Wyckoff schematic. It means that a lot of times when banks want to move price in a certain direction, they will accumulate orders in a certain way, right? Because they're not going to put 900 million lots in one order. They're going to put 900 million lots dispersed over a lot of orders. Why? Because then they can close partials a lot easier. So what are they going to do? Let's say they move price from here to here to accumulate orders. To move price upward, what did they need to do? They needed to put accumulate, right? And they needed to put a lot of buy orders, right? Buy, right? They needed to do that to move price. Now, we know that they had to do this to move price upward, so they had to sacrifice their capital, right? So right now, these orders are blue, right? These orders down here are blue, but they are putting them there so that they can counteract the amount of sells that they're going to put at this point right here. So the red are sells, right? So they're going to start putting sell. And what do you think price is going to do at that point? It's going to react off of it, right? Now, this is on lower time frames. So let's keep that in consideration, right? Sell. We have a couple buys dispersed in here just to counteract the sells so that the market doesn't completely crash on itself, right? We have more sell. Now, let's say that this right here is the green candle. What do you guys think the average of this green candle is going to be? Let's say that this is on the 4 hour, right? Let's say this right here is on the 4 hour. And let's say this right here is on, let's say, the 1 minute. Where do you guys think that price is going to make its move at this position? Most likely, the average of all of these positions is going to be around the 50%. Okay, is going to be around the 50%. So now we know why we touch 50% on an order block, because that's how bank logic works, right? That's how bank logic essentially expresses itself in the market. So power of three right here, right, is something that we're going to go back to. Power of three is accumulation, manipulation, and distribution of profits. So what does that mean? Well, you accumulated positions for the sell up here, right? You also accumulated buys for hedging positions, right, to counteract the sells down there. So you're accumulating positions on the way up. Now you're manipulating price. Where in this are you manipulating price? Was it A, the move up? Was it B, the move down? Or was it C, the actual break of structure?
Oh, it's A. So to make people believe it's going up, it's really going down.
Okay, so we have one answer, A. What about everybody else? Can anybody else tell me? A, B, or C?
I would say B.
Why would you say B? So remember, A is the move up, B is the move down, and C is the break of structure. I see a lot of A's. I see some B's.
Is B bullish?
No, B
Bullish
is
move
the
there?
move down.
Oh, that's a move down.
A
Oh,
is the move up. Okay, so let's go over this. Right here, it's A. Why would it be A? Because the accumulation of positions manipulates the market into going into the opposite direction, right? It's going into the opposite direction and it's accumulating positions in the opposite direction to hedge the actual move. How do we know this is going to happen? This is very, very simple. Banks do this for a reason. Banks do this because they know how gullible traders are. They also know how dumb money works. And they're going to take it, right? They're going to take it. Oh, no, Joe, you are completely correct. You are completely correct. You
Okay.
said it perfectly. Like really, you said what I'm about to say in your own words. They accumulate positions in the wrong direction for two reasons. The first reason, it's because they themselves, right, want to move the market in a certain position, right? They need to hedge the market in the opposite direction so that the market doesn't crash, right? So, since they accumulate these inverse positions, what is that going to manipulate the market to do? To go in the wrong direction, right? Now, this serves two purposes. The first purpose is very simple. The first purpose is liquidity, okay? And then the second purpose is accumulation of hedge positions.
Just got a quick question.
Mm-hmm.
On the move down, as it's going down, that pullback, wouldn't those little pullbacks be considered manipulation as well? Manipulation of price?
Yes. Yeah. Yeah.
Yeah,
You
that's what I was
consider the
referring to.
manipulation of price. Yeah.
Correct. That's what I was referring to about that little pullback. That's why I asked you if that was a bullish candle on that first pullback there, right there at B, where you have
Oh,
B
yeah,
right
yeah, yeah.
there.
So,
Yeah.
yeah, I mean, it would be, but at that point, they could be, adding more bullish positions there, just to counteract the amount of sheer sells that they had or something like
Correct.
that, right? They could be doing like at every single pullback, they could be adding more bullish positions, right? Just to hedge their positions. So that definitely can be manipulation. And also, let's say you're one of those new scalping traders that are using 1 minute RSI stochastic. Okay. Whenever you see this move up, what is your stochastic and your RSI going to tell you?
To buy.
It's a perfect time to buy, right?
Yeah.
And since it's a perfect time to buy, what's the market going to do? It's going to say, thank you for your liquidity. Thanks for playing, right? Come back later today when you're done crying. So why does the market do this? Very simple. Because of the theory of power of three. The accumulation of positions, the manipulation of the market, and the distribution of profits. The distribution of profits happens after this. So it happens coming back to the order block. It happens after with the giant move down. Okay. Some people had some questions about the order block. And I probably should be talking about this in the small class. So I'm probably going to talk about this in the small class because I'm giving a lot of information to the other people. So we'll talk about that in the small class. But what ends up happening is, does everybody understand how inefficiencies are formed? Why inefficiencies are formed? Does everybody understand how order blocks are formed? Because what ends up happening what is an order block? It literally says it in the name. It's where a bunch of bank orders are. It's where a bunch of bank orders are. So why does it surprise you when banks come back up to an order block and immediately reject off of it, off of the 50% of it, or off of the open of it? It shouldn't surprise you because that's where a lot of the orders are, right? So essentially, we can consider each piece of structure, we can consider it a magnet to price. And why would we consider it a magnet to price? Well, very simply, you'd consider it a magnet to price because of the fact that you still have to come back up there and mitigate what orders?
Those sell orders at the top.
Those sell orders at the top. Perfect. So let me okay, so does everybody understand this? Does everybody understand power of three? How this works? Everybody understands this? I can delete it. Yes, there's 19 people in here. I need 19 answers, please. Oh wait, 18 people because I'm in here twice. Perfect. 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 All right, awesome. So now let's let's go ahead and delete this really quickly so that we can go back to the actual order block. And for people that are thinking like, oh, he's just going over order blocks. No, I'm explaining to you why an order block happens. And this will help you later in your trading, because if you understand why, you'll understand how. And if you understand how, you'll understand when it is and when it shouldn't be. A lot of people have trouble spotting whether or not this is an order block or it's not an order block. And it would be very easy if you would consider bank logic, which is, I hope, is what I'm doing right now and explaining to you guys a little bit better. So how do we distinguish whether or not an order block is actually an order block? Well, usually there's a couple things that distinguish it. Usually, if there are a lot of bank orders here, what's the market going to do right after? It's going to react to it, which means that price should not stagger. It should not just be consolidating. Sometimes it will, but it shouldn't do this in extended periods of time. It shouldn't do this for like 20, 30 pips. It should have at least a reaction, right? It should have a reaction. Now, sometimes price wants to come back up, fill it immediately, keep going back down, right? Which is perfectly valid. This is still an order block. But at the same time, we want to be conscious that if the market makes an upward candle, then a downward candle, and that goes 5 pips and then comes back up, is this an order block? No. Why? There's not enough orders there. For one, or for two, you're just wrong. Now, usually, what time frames did I tell you guys that banks are on? Are they on the 5 minute?
No, they're on the higher time frame, about the 4 hour and up.
4 hour and up.
Mhm.
So a lot of times you can zoom in and you can see a 4 hour order block on the 1 hour. So I'd still even consider 1 hour order blocks somewhat valid. Are they amazingly valid? Not really, but they're still valid, right? We won't discriminate against 1 hour order blocks. So let's say we're on the 4 hour. If we're on the 4 hour and we see a perfect setting up like this, what can we assume are at this position? What did we just go over?
Sells
There are
the
cells here, right?
orders. Mhm.
So let's say they have 900 million sells, and they have no, not 4 3 is too low. Let's say they have 4 million buys. What kind of reaction can we expect here?
An inefficiency move. Inefficient move.
No, it would be an efficient move. Well, I think it'd be fast, but I think it'd be efficient. Right. Let's actually up the ante just a little bit so that we don't like get confused as much on like what the move is actually going to be. Let's say it's like 9 to 6, right? That's a good ratio. That's a good ratio. Because we are going to move the market downward, but we are going to have to come back up from orders, right? So in this case, we have 6 million buys that are in drawdown in this case, right? Because what's going to happen? What's wrong color? Price is going to move away from it, right? And it'll start consolidating. Let's say that for an example, right? So we got a nice reaction off of this position. Why did we get a nice reaction? Well, the buy to sell ratio was good. There was a reaction off of it. And there was a position where we can very obviously say, hey, there's liquidity back here because of the fact that we moved off of it, right? So that order block is going to be very, very helpful to us in the future. Now, when we spot a situation like this, how can we play this position? Should we be buying into the sell? Or should we wait? Should we be waiting patiently into this in for the sell?
Wait patiently. Don't chase the trade. Chase the setup.
Perfectly. Perfectly said. So a lot of people will try to buy into the sell. They'll try to catch a falling knife. So they'll say, oh, well, I know price is going to come back up here, so why don't I catch the extra pips? Okay. Sure. Let's say you do that. Let's say that you don't see that about 40 pips more downward, there is liquidity. Let's say about 40 pips down, there's still liquidity down there that needs to be taken. Let's say there's an inefficiency. Or let's say there's another order block down there. Well, that's unfortunate because you just bought right here full margin with your stop loss at 3 pips because you think you're cool, right? And you don't know what you're doing. And this is not an insult to you guys. I've seen people do this and try to do this as soon as they see Bootcamp 1 and they fail miserably. So you guys know what you're doing now. But a lot of people that I've seen, they're like, oh, why didn't this work? Dude, you didn't see the full picture. Like you have to understand the full picture. And what happens with most of these people is that they're looking at the 30-minute. They're looking at the 15. Some are looking at the hour, but they're looking at it wrong. Right? So when they do this type of thing, I don't feel sorry for them because it's like, dude, you did, like, let's say price is in consolidation right here and it creates equal lows. Well, obviously you have liquidity there. Why would you buy off of it? There's no reason for you to buy off of it unless there's an accumulation schematic, right? There's no reason to. Why? Because it just created liquidity. Let's say, and as we said, 40 pips more down, we have another piece of liquidity. So unless you are very, very comfortable day trading and you've gotten very, very comfortable with these lower time frames, and analyzing higher time frames, and then going down and actually catching them on lower time frames, then you could possibly catch the buy. However, I would not suggest it because a lot of times price will move sporadically, because at that point, banks aren't really looking for the move up. They're looking for the move down again. They're just closing orders and taking profit at certain points of liquidity or liquidity pools. They're dipping into as many liquidity pools as they can so that when they come back up and they take the buy up, they can very, very safely do so. Does that make sense?
Yes, sir.
So let's simulate. Let's say that in this case, the cool kid was right and it does buy off of this. What can we expect being right here? Let's say price does actually reject off of this position, right? What can we expect being right here? That was awful. I'm sorry. What can we expect?
Some sell orders and some stop losses.
We can expect some stop losses, but we should also be expecting what? Buy
Sell
orders
orders,
and
sell orders as well.
buy orders and sell orders, right? Since they're taking those buy orders and those sell orders at the same time, we can also expect that price in this case is going to have liquidity down here, right? This would be another liquidity pool. Why would this be another liquidity pool? Well, because you have these orders being set up here. A lot of times liquidity pools end up just being banks taking orders again. So you see how price moved away very well in this case, right? It moved away pretty strongly. So we can assume that there are a lot of buy orders in this position with hedged sell orders in this position, meaning that this just created a liquidity pool. Perfecto. This also becomes the, what do you guys think this becomes?
Return of origin, RTO.
The origin, right?
Yeah, return of origin.
Well, the return to origin is the move, right? The
Oh, yeah,
origin point is
right.
here where the orders are, right?
Correct. Where it started at
Well,
initially.
it should be lower, but you guys get the point. So
Yeah.
that becomes the origin. Now, when price zooms all the way back up here, and we have our order, we have our limit order placed right there, what's going to end up happening? What should happen? Where should our stop loss be?
Um, behind the on top, yeah, all the way at the top of that wick, behind the wick.
For me, it's going to be slightly behind the wick, right? That's what I have it at, slightly behind the wick, just because I've seen so many times that it hits the end of the candle and then we're just sad, right? So a lot of times I place it right behind it, and let's say price goes a little bit higher and then drops. Where would be our first take profit? Where would be our first take profit? Where would be our first take profit? The last high? We're selling. We're selling here though. Our entry was right here. Our entry was right here. Oh, perfect. Low. So yeah, so the low would be right here. And what would this become? The return to origin, right? And that return to origin would become our take profit, or our take profit one, which would become down here. And if we're an overall bearish market structure, or BMS, right? BMS, what do you guys think is going to end up happening here? Are we going to overshoot this? Like, are we going to go past it? Most probably. Most probably we're going to go past it. Why? Because at that point, we just got all of the sells that were down here, where they just came into profit, and we just nulled out these buys that pushed us back up to our orders back here at the order block. Does everybody understand how an order block works now? Does everybody understand?
Yes.
Yes,
Does this
sir.
make sense? Does this make sense to everybody? Did this enlighten you guys? So we've now discovered how inefficiencies are formed. We've discovered how order blocks are formed. Now, how can we, as traders, incorporate bank logic into our trading? And actually, do you guys want me to go through some examples of this? I'll go through some examples. How about that?
Yes.
I'll go through some examples and give me one moment. Is this helping you guys out, by the way? I hope this is. I hope this definitely is helping you guys out. I'm trying to look through my notes to see which examples I had written down. Aha, yeah, this is the first one. So let me actually go over the first example. So this is actually a trade that I took independently. I didn't really mention it to anybody because I wanted you guys to be finding your own setups. Now, based off of the hour, what do we see? What is the order block here? Which is the order block here? And let me get rid of the answer before people look at it. Where is the order block here? Is it here, here, or here?
Probably the middle one.
The middle one. Okay, the middle one. People say the middle one.
Third one.
Yeah, I agree with the middle as well.
The third one. Okay, some people say the third one. All right. Well, if we can't really agree, let's go on a little bit higher of a time frame. Now, does this look a little bit clearer? Maybe if you go to the
No,
4.
it's the higher time frame is the look like it's the last one now.
Well, it looks like it's a bit in the middle of both, right? That's why we went up
What
to the higher
is
time frame.
that? Oh, that's a 4. Yeah.
On the 4 hour, we can see that up here, there was some type of power of 3. How can we assume that this is a power of 3 here? That this
Doji.
candle right here is a power of 3?
Mm-hmm.
Because it's a lower high.
This candle right here that I just highlighted. How can we assume that this is a power of 3?
Would it be safe to say because it's a lower high?
Lower high? I don't think so. Think about the steps to power of 3. Think about the steps. What are the steps?
So you have accumulation over there, and
Accumulation of what?
Orders.
Orders. In what direction?
Shit, both.
now they're still bearish. So though, it's still
Okay.
both.
Okay. All right. Let's expand on that. Let's expand on that a little bit. Let's expand a little bit on that. What do we see happen right here?
Actually, yeah, it's both because we have the week. It's going up. Those long weeks.
Right.
Yeah.
So what ends up happening? We come up, right?
Mm-hmm.
And we accumulate bearish orders. But we also accumulate bullish orders,
Mm-hmm.
which is accumulation and manipulation in one move.
Mm-hmm.
Accumulation, manipulation, and then what?
Distribution.
Of profit. So we have power of 3 moving this order block away. Now, if we go back into lower time frames on the hour, we can easily see that it's between these two. So for me, I'd go for the open of this order block. And I'd say, well, this is really where it originated. This just kind of mitigated the middle of the candle, which to me is fine. I'm like, okay, whatever. I'm gonna open. I'm gonna tap the open of the actual candle. I'm gonna go a little bit above it, just so that price doesn't miss. What ends up happening? Price taps it to the wick and then falls. Correct? Price taps it to the wick and then falls. What do you guys think price taps it to the wick and then falls? What is there?
Bank orders.
Bank orders. Not only are bank orders there, what do you guys think is going to happen to the to the positions that were in the past here? What just happened to
Oh, it
all of the
triggers
buy
Got
them.
taken out.
positions?
It triggers them in.
Right, it triggers them in for further liquidity, because what just ended up happening down here? Look at what it targeted. What was targeted here?
Expose liquidity.
Ah, exposed liquidity. Well, not really exposed liquidity, but there's liquidity down here, right?
Mm-hmm.
Yeah, definitely.
Not
Just
only is
looks
there
exposed.
liquidity here, there's liquidity. Well, actually, that you see how this liquidity was here?
Yeah.
What happened to it? Got raided,
It
right?
got taken out.
Yeah, I got filled. Yeah.
What was the liquidity that wasn't taken out yet? Back here. We had two positions. We had one here, and we had one here. Both of which are liquidity that needs to be taken. What ends up happening later? Oh, we see sharp moves off of it. Price mitigated, right? Let's say they were bank orders right here. They came back and were mitigated immediately. But those bank orders, there had to have been more orders back here that were in drawdown. Let's say they were mitigated back here. Perfect. There are bank orders here that need to be mitigated. There's bearish market structure here. There's bearish market structure. If there's bearish market structure, what can we assume? That this target here is going to get overshot, correct? This target's going to get overshot. So what's going to happen? We can most probably expect price to push lower than this position, even though that this would be our first take profit, right? Now, that is if we actually take the sell off of the mitigation of the order block, which is perfectly fine. We could have. We could have taken also the sell off of this right here. We could have also taken it off the breaker. Sorry, the mitigation block. That's perfectly fine as well. But what would have been better for us to do? It would have been better for us to wait for this order block and then continue taking this position. Now, why would we come back up here? Well, we have to come back up there. Why would we come back up there? Because there are still orders that are in drawdown, correct?
Yeah, mitigate those losses.
There's still bullish positions that are in drawdown, even if there are no more bearish positions that are in drawdown, correct?
Yep.
There's still these orders that we need to take out. And if those orders still need to be taken out, what are we going to target? The order block, correct?
Yep.
Ah. Doesn't that make a lot more sense?
Yes.
Doesn't that make a lot more? Doesn't that just clear up a whole lot of things? So now we see this liquidity up here because it's not just bank orders, it's liquidity. Right? And when we see this liquidity, we say, oh, well, price is most probably going to return to this area. Boom. And where did we bounce off of? We just bounced off of an order block. Now, not only that, what did we also create?
Selling climax.
Not yet. But we did end up creating liquid lows, right?
Yeah.
We ended up creating lows that end up sharing our liquidity. So what can we expect in the future? Actually, we already got it. Look at this fill of the inefficiency right here. Look at this breaker. So let's go over breakers a little bit. You guys see how this high was created? You guys see how this high was created right here? Now, what were the last candles that actually formed that? These two right here, the last bearish candles before the move up to break equal highs, right? Do you guys see these two? Do you guys see these two candles right here? That's the breaker block.
It's like an order block.
Similar, but inverted. Right. So you see how these highs were created right here, right?
Yeah.
These highs were created. Now, price broke through them and then broke back down, right? It came back down. Price broke through them and came back down. When price broke through them and came back down, what was the move? Where were the last bearish candles before the move that originated the move up? Where is the origin? Now that we've introduced return to origin, where is the origin?
Yeah, it's right there where those two bearish candles are at. That makes sense now. Good explanation. Huh. I
The
get it.
origin is right here, right?
Yep.
The origin candles end up being the candles that move price up to hit the order block, but it broke an equal high, which then becomes a breaker. If it meets equal highs, it's a mitigation block, which ends up being where we could have gotten a re-entry right here. Usually it's around 50% as well. Sometimes it just hits the open, so just be considerate of both of them. So let's say we would have taken a short position off of the top of the candle or off of the beginning of the candle. Usually for me, I put my stop loss behind the breaker, or if I want to be more conservative, just put it at the top that was broken. Usually that's a giant amount, so usually I just put it at the end of the breaker. And then from there we could probably overshoot these lows and then take them out, right? If we want to be a little bit more conservative with our capital, we could say, well, we're probably going to take out these lows, or we could target a quarter point, which in this case would be 68.70, or where would that be? That would be 75, 69.75. I believe it would be. Oh no, it would be a lot lower. So we could target a minor quarter, which would be 125. Which would still be around here. So this area right here could be our final target, in which we could say, hey, there's liquidity down here that will most probably move the market. Why do we assume that? What is right here?
Some exposed liquidity sitting there.
Not really exposed liquidity. It's not exposed liquidity. What is here, though, is we have a strong move up, which means that bank orders were involved, right? And if bank orders were involved, what is there?
Sells as well.
Liquidity as well, right?
Yep.
So if those sell orders were there, what will most probably be our next target?
Buy to go up.
No, a sell in going here, right? We're already in a sell from up here,
Oh, okay.
which
You
means
mean
that
to
most
continue
probably we're
down?
looking for re-entry and then coming back down here because we do have liquidity right here. So most probably if we continue up this bearish market structure that's right here, we will most probably break and overshoot these lows, coming back down to our final target, which is right here, because that's where the banks actually had their orders at. And look how perfectly, I don't know if Ladarian's still here, look how perfectly he hit the quarter point and rejected off of it. You see that, Ladarian? I don't know if he's still here. I don't think he's still here. No, he left. Well, still, it bounced off of a quarter point. Do you guys see that?
Yeah.
Now, what type of schematic is this?
A redistribution?
Right, perfect. Redistribution. A redistribution schematic.
Can I ask a question here really quickly about the breaker block?
Yeah.
Would it be safe to say that they're at the breaker block? Would that be the area in which a move is made to break the last high, the most recent high?
Yeah.
Gotcha.
That's kind of the definition of the breaker block, because it's a breaking block.
So it's sort of, yeah. So yeah, that's what I was getting at. That it's self-explanatory. The name. I just wanted to be clear.
Meanwhile, mitigation would be the mitigation of equal highs.
Gotcha. Yeah. Well, the terms are pretty self-explanatory. Okay, I'm getting
Yep.
a better understanding.
So if we look at this again, right, the breaker right here were these two candles. The reason why I included the second candle was simply because the first one was way too small, and usually we want to give a little bit of range for the market. If that makes sense. Has this helped you guys?
Yeah.
Now here's a good one. That it's like here's the PSY, here's the buying climax, here's the automatic rally, here's the secondary test, Here's the established range. Here we have the upthrust. In this case, it didn't have an upthrust after distribution. We had a test immediately after. We had a second test, and then we had our last point of supply. This could also be considered a last point of supply, but most importantly, we had a break of structure. Since we had this break of structure, we could very easily say, oh, this break of structure coming back up to an order block and then shooting down. So that would have been an almost guaranteed position there. You will really never see price break through these highs after making a setup like this, because price has already priced in its positions at that point. So at this point, we know that price has entries all the way up here for sells and for buys. However, price with the test in the last point of supply ends up mitigating those positions so that price doesn't have to come all the way back up here. That's the beauty and how Wyckoff works, because up here we have buy orders, but most importantly, we have massive amounts of sell orders, right? Sell orders, they can close at any time, but buy orders, they can't, right? Because sell orders are in profit, buy orders are not. So they move all of these pips down here. Now they retrace. What do you think they retrace?
To mitigate and also to take out those orders, those buy orders.
To mitigate and to take out those buy orders. They're
Yeah,
mitigating those buy orders, right? So now when they
correct.
take them out once, boom, now they still have to move down again, right? But they have less buy orders here. They mitigate them again, boom, so they're over here. Now what happens here? They can close the rest of them there, or they can leave a small number of them there and then just manage them on the way down. And what do they still have up here? They still have their sell orders up there, right? Why do they still have their sell orders? Well, because they can close at them anytime. And I'm pretty sure on the way down, they also took profit on those positions as much as they wanted to. Because at that point, they know where price is going. They hit their target. They're content. They take their standing liquidity, and we're done. Thank you for playing. Does that make sense? At all?
Yes.
Like,
Yes, it
did
does.
this help enlighten you guys a little bit more?
Yeah.
Got a question here. Where the breaker block is at, it are there times where we can expect it to respect that breaker block that you drew out there? See that rectangular box that you drew out?
This one right
That
here?
structure? Yes. Can at times we expect it to respect it as it's coming down?
I mean, yeah,
Let's
that's what it
let's
did
after.
here.
Well, not there, but just on its way down. See when it broke the block, went up and respected that quarter point on its way down. Could we sometimes anticipate it to not break through structure right there and just like
Um,
bounce off of it and go up, go back up again to retest
to
the quarter point?
bounce. Yeah.
See what I'm
Oh,
saying? Yeah,
I see what you're saying.
yeah.
Yeah,
It
but
played
this
a lot like
becomes a
that. I
breaker
noticed.
block after the break downward.
So it has to break through first for us to
Yeah.
validate it.
I mean, yeah,
Gotcha.
or else we wouldn't know. This would just be another retracement and movement upward.
Ah, okay.
So
Good.
the reason
Expecting
why I say don't
fast.
predict the market is you have to know where liquidity is, and you can expect price to move up to that position, but then you have to react off of it. So I didn't know this was a breaker at this point. I
Hmm.
knew it was a breaker at that point because that was the
Correct.
last break of a high, right? That was the last break. That was a high. This was the area that originated it. So I expected it a reentry around this area.
Okay, gotcha.
Hey James, did you record like the video?
Did I what?
Did you record the call?
Yes, I did.
Okay, perfect. Thank you.
So that's essentially what price is doing at that position, right? If that makes a lot more sense. Does this make a lot more sense to you guys?
Yes, sir. Most definitely. No.
Awesome. Awesome. I love to hear that. Does anybody have any final questions? We do have a class afterwards, so for people specifically. So we're gonna go ahead and get started with them really quickly because it is getting a little bit late over here in the East Coast. So does anybody have any concluding questions for the people that were here as guests? No problem, Joe. Actually, I want to talk to you, Joe, afterward or whenever you're free, bro. because the guys I wanna show them your potential. Garrison. All right, guys. Thank you guys. For everybody that's in the class afterward, I'll send out another link for you guys. Thank you guys for coming.